Hi, this is Mark, hashtag Loan Dad, here with a little bit of fatherly advice from the mortgage world, just to give you a quick update on some market stuff. I'll fly really high because I know when you drill down to the details on there, it's really boring. So last week, the first week in March, we said, hey, you know what? Next week we're going to see some improvement. We're expecting some good news from Fed, which has become pretty rare lately, to be honest with you. But the week of March 6 through 10, yes, we saw a little bit of increase this week. So we got some good news, slight improvement in rate. And we kind of anticipate next week might not be such a bad week either. This week we saw the Bureau of Labor and Statistics job report, and that came out better than expected. That was a good thing. We also saw the Fed affecting banking, affecting the markets, and not necessarily in a good way. But when that happens, the mortgage bond securities market tends to react in a way that helps mortgage rates favorably. We saw that this week. We've seen a little bit of improvement. We're heading back down into the sixes, we hope, sometime soon. Next week, the inflation numbers come out. We're also expecting the initial jobless claims report to come out. That'd be on Thursday. And so we're hoping maybe some more positive news on the mortgage front, because February was brutal. It was a cold, hard month in the mortgage business. But now things are heating up, and seasonality is affecting real estate, and so we're expecting rates to cooperate and the market to really get busier. So let me just end this short video with my personal opinion. Trust a professional. Trust a professional is the mantra. I'm going to give you two quick examples why you should trust a professional. I've got to get some AC work done on my car because it's starting to heat up, and I've got to get some work on that thing. I got to get it chilled. I'm not going to try to do it myself. I'm not going to take it to a realtor. I'm not going to take it to another loan officer. Guess what? I'm going to take it to a mechanic. I've had two clients decide this week that, oh, we're just not going to buy right now. One of them said she wants to build a house instead of buy an existing home. Guess what? Right now in this business, with the high cost of goods and services and supply chain issues, it's not necessarily a great plan to start with a new build. Yes, it can be done. We can make it happen, but buying existing is the conventional wisdom. If you talk to somebody who's in the business, who knows what's going on, buy an existing home, and then guess what? Buy the house, marry the house, date the rate. We'll help you refi within the next 3 years. If you decide to refi, we'll do that without any lender fees. That's a pretty cool deal. The second example I have is a client who decided not to purchase based on mortgage insurance fears, which brings up the whole subject of appreciation, right? So if you know what appreciation is, it's not all about, oh, hey, I love my puppy. See that picture in the in the background? Yeah, there is a picture up there of my dog, and I appreciate my dog, and I appreciate the people around me, but that's not the kind of appreciation we're talking about here now, is it? We're talking about appreciation, homes that purchase. I've got some data on my computer right over here, so I'm going to cheat for just a second. I'm going to take a peek down here at some real numbers that I've generated for Harris County, Texas. A home purchased at $300,000 this year is forecast to be worth somewhere between $346,000 and $351,000 in only 5 years' time. That means that coupled with amortization, and amortization means the amount of principal that you pay off as you make your monthly mortgage payments, coupled with amortization, that's somewhere between $63,000 and $67,000 in equity gain over the next 5 years. If you're buying a house, that's $63,000. That's just free money added to your personal wealth. In the same period of time, this particular client would have been out about $1,800 a year in mortgage insurance. So let's, to put that in perspective, you're gonna not buy a house because over the coming 5 years, you're gonna pay $9,000 worth of mortgage insurance, but you're gonna turn down $63,000 in personal net gain. All right, so that's still more than $50,000 net gain in your personal wealth. I think it's worth buying a house. If you talk to a professional and you look at the data, you can figure that out. And I'll be having some more conversations to these young clients of mine who are considering a build and are considering not buying because of mortgage insurance. There's some smart decisions out there to be made. Trust a pro. My name is Mark McVeigh. I am the Loan Dad, and I would love to help you buy a house. And I love to partner with great realtors that are out there right now. Have a fantastic weekend.